Hey, Brian Mullins here. Today we're going to be talking about cap rates. What are cap rates? Well, if you're thinking about investing in real estate, this is a really important number to know. I know we cover a lot of topics about personal finance. Honestly, real estate investing is one of the best investments to make long term to really generate wealth. So before you buy a property, you've got to make sure you understand what kind of money you're going to make and is it a good investment. So that's what we're going to be looking at today. A cap rate is going to tell us what type of return we're going to see on our investment. And then we'll determine if that is a long-term investment you should buy or if it's one you should walk away from. All right, so we're gonna start off at a high level. What is cap rate? So here's the formula, put up on the screen for you. Cap rate equals your NOI divided by your acquisition cost or your current value of the property. I know that may seem like a lot of Latin, a lot of gibberish, but we're gonna dive into what each one of those mean right now. All right. NOI, here's the big reveal, stands for net operating income. Net operating income is how much money you're taking home at the end of the day. One thing you're going to notice is this does not include mortgage because we're trying to even this out based upon all investors. So whether you have a mortgage with a higher rate or you have cash, we don't care. We just want to see what type of return the asset's going to bring. Your cost of the capital is completely different. So let's start off with our income. So all we're doing is taking our income minus our expenses. Our income, the biggest income is going to be rent. You're also going to have some other little incomes that come in. So let's say you have an apartment or a multifamily, you may charge for parking. So you could have parking fees. Typically with multifamily, you may have a laundry facility on site. So those little coin operated machines, that's going to be extra income. Late fees, all those are going to be extra income that comes in. Now, if you're looking at just a normal house, honestly, I would just look at rent. I kind of look at late fees as a bonus. I don't really count that. I don't expect that to come in. I honestly hope people pay their bills on time. But if they don't, I get a late fee for the inconvenience of them being late. And sometimes I have to go post notice and stuff like that. So make sure that you are counting at least for rent. And if you're buying something multifamily, account for the extra income because it could be significant like laundry or parking. All right, expenses. So this is what it's costing you to own this asset. So the first one's not really an expense, but kind of, we're gonna count for it, is vacancies. So how much time the property is going to be vacant, how much time you're going to be showing the house, how much time there's not going to be income coming in. So you really need to know your market to see what this is going to be. So if you're building a multifamily, you're probably going to have vacancies, especially if you're building a big multifamily. If you're building a 400 unit apartment complex, you're most likely not going to get 400 tenants like that. It's probably going to take you a year or two to fully build up all that occupancy. If you're buying a house, it really depends on what's happening right now. So right now we're shooting this midway through 2021. There is a ton of demand and not enough supply for rentals. My vacancy is essentially at zero. So that's kind of what I'm counting right now. And I've been doing this now for 7 years or so, and I've really never had much vacancy. So I don't really count for that. But if you don't know, count for 10%. That's probably going to be high, but it's going to be a good conservative estimate. Next is going to be your insurance. So your insurance, you need to call your insurance agent and see how much it's going to be. Now, it's important, we're going to do a little subtopic here. It's important to know how your insurance works. So there's two types of insurance. You can get ACV or you can get replacement cost. Make sure you compare both because especially on rentals, if you're going to have a whole bunch, you probably want to go with ACV. We'll do another video on that sometime. That's a quick little teaser. Also, make sure they're giving you a landlord policy because you don't need to have the contents covered for the tenant because that's not your contents, that's not your problem. That's what renter's insurance is for. Make sure you check out what your insurance is going to be. The third thing is going to be your maintenance. So how much maintenance are you going to have on the building? This really depends. You don't know. I count for about $100 a month for each door that I have. That really varies because I may have one year where I have a ton of maintenance. I may have to replace an air conditioner and it costs me a couple $1,000s. That's just going to blow my budget for the year. But then the next year I have $50 in maintenance, maybe $100 in maintenance. So it kind of evens out. What I found is that $100 is a pretty fair number. It really depends on your region though. Right now I'm in Oklahoma. Labor is relatively cheap, parts are relatively cheap. If I'm in California, labor is a lot more. If I'm in Hawaii, parts and labor are a lot more. So just kind of keep it in mind that your maintenance will vary based upon the region that you're in. And the last one is going to be your taxes. Taxes are one of those things that is going to vary based upon where you live. So where I'm from, our taxes are limited to only increasing at 3% or 5% a year, 3% for homesteaded properties, 5% for non-homesteaded properties, so rental properties. That is the max the value can appreciate. So whenever you go buy a property, let's say someone has lived in a house for 30 years. If we had some years along the way, which we have, that the prices increase more than 3 or 5%, when I buy the property, the taxes are going to be really low. But they're able to reset all those taxes whenever I buy the property. So what may have been really low is now really high. So keep that in mind that they're going to reassess most likely whenever you buy the property. So that's going to raise your taxes, especially if the previous owners owned it for a long time. So you add all those numbers up and that's going to give you your total expense for that property. So now that we have our expenses and our income, we're going to take those two, we're going to subtract our income from our expenses, and this is going to be our NOI, our net operating income. This is how much money you would make from the property if you paid cash for it. If you had no other expenses for financing, in theory, this is how much money you should make every year. Now, you will probably have a mortgage, so take that into account. But think about this, when that is paid off, this is how much money you're going to be netting at the end of the day. That's a lot. And you've got appreciation on top of that. So that's fun to think about, but this is a really important number to know when calculating our cap rate. All right, so now we have our NOI. That's our numerator. Our denominator is our acquisition cost or our market value of the property. So acquisition cost should be pretty easy. This is how much you're paying for the property. But keep in mind, this is how much you're paying for the property plus anything you have to put into it to get it to marketable condition. So let's say that I buy a house for $50,000, it's trashed out, I gotta spend $30,000 to get it in rentable condition. I actually have $80,000 in the house. So keep that in mind, it's not 50. Your numbers are gonna look really good if you use 50. We need to use the number that's total cost to get it in marketable condition. Now, the times we would use our market value is gonna be whenever we're looking at our asset and deciding if we wanna keep this asset or sell this asset. So let's say I've got a property that I bought for $50,000 and is now worth $80,000. So I'm gonna base my calculations on $80,000 because I know I could sell it, I could net $80,000. How much am I making on this? Is my cap rate high enough, or is this other potential investment a better investment? So maybe I sell this one that's at a cap rate of 8% to go to a 10% cap rate. So now I'm actually improving myself. It's like looking at a bond, right? If you're looking at a bond and the bond is at a certain percentage and you could go to another bond that's similar rating but is at a higher percentage, why would you not take it? So that's what we're looking at whenever we're looking at our acquisition cost or current market value of the property to determine our cap rate. So now we've learned all the terminology, let's look at a real world application. So we're gonna talk about a property I just bought, I'm really excited about it. It is near our office, it's in an old part of town, it's a super cute house. So I wanna go through what we were looking at whenever we decided to put an offer in and was it worth it? So let's get started. So this property is going to rent, I anticipated for $850 a month. I have since rented out and I was correct. I rented it for $850 a month. So there's 12 months in a year, last I checked. So that gives me a total of $10,200 in income. I would love to keep all that, but it does cost money to make money. So now we need to look at what my expenses are. So my taxes are $850-ish a year is what I'm calculating. This is like we talked about before, the old owner was paying about $700 a year. Based upon what I think they're gonna value it for, I went ahead and bumped that up to $850. I could be wrong, I won't know until we get to the end of the year when they release tax statements. My insurance is $900 a year. It's a little high, but this is an older house, and so sometimes that can end up increasing the cost. And then my maintenance, like we already talked about, I estimate $100 a month per door. So that is a total of $1,200 in maintenance. Have I spent any money on this house yet? No. I've had the tenant in there for 4 months or so at this point and haven't had to spend a dime. The house was also in good shape when we started, so that was even better. So that gives me a total of $2,950 in expenses. So not bad, fairly low expenses. So my NOI is a really simple calculation. We're gonna take our total income of $10,200. I don't really have anything extra. I don't have any laundry or parking because this is a single family house. And I'm gonna subtract out my expenses of $2,950. This gives me a total of $7,280. So $7,280 is my NOI. This is how much I would be making on the property if I paid cash for it. That would be pretty nice. So to get our cap rate, if we remember the formula, it is cap rate equals NOI divided by my acquisition cost. So I paid $85,000 is what my bid was for this, and I won it, $85,000. $7,280 divided by $85,000 is a cap rate of 8.56%. That's pretty good. If you look at the stock market, that's about the average, but here's what's not being taken into account with this. This is my cash return. This is how much I'm going to make on it. What I'm not taking into account is the appreciation on the property. That's one of the biggest things that's missing on this. Is every single month, this property is most likely appreciating. Real estate doesn't always appreciate, but as a general rule, it does. So let's say, we have another 3% a year on average of appreciation. So my 8.5% now goes to 11.5%. That is definitely outpacing what I can get in the stock market. So keep that in mind whenever you're doing this, but this is a cap rate of 8.56. So where would I use this number? Well, I want to look at what's going on in the neighborhood. I want to look at how much other properties are getting sold for, how much they're getting rented for, and what their cap rate is. Is this easily accessible information? Not really, especially not the rent. I can definitely go in and I can find how much the property is being sold for. Some markets it may be harder than others, but around here, it's all public record. So I can see what the property is getting sold for. I can guesstimate what they're renting. I may be able to find on Zillow what they're renting it for, but I can guesstimate what the rent is. And then I can work backwards into it of what their cap rate is. And so I can kind of see in the neighborhood what my cap rate is typically going to be around. So I want to be somewhere similar to that whenever I'm looking at my investment. You also may have a personal number that is your minimum cap rate. So for me, my minimum cap rate that I'm going to buy is 8%. If I can't get 8%, I'm not buying it. I've known some people that buy at 6% cap rates. That's not me. Typically, I take out a mortgage. My mortgage rate's going to be 4.5% or so, 4 to 5%. I'm not making any money if my cap rate is only at 6%. So I don't even mess with those. If I'm not making 8%, I'd walk away from it. Now, another thing that can increase your cap rate is depending on where you are. So in a decent end of town around here, it's going to be around 8%. If you're in a really nice end of town, it may be a little bit lower, but typically it's around 8% for a decent end of town. You go out into what we'll call the ghetto, the lower income part of town, much more Section 8, you're going to be finding cap rates 10, even 12%. So you can make really good return on your money, but that comes at an expense. You're having to deal with probably not the best tenants who may not take great care of your house. You actually may have some more expenses. So you have to take that into account. If I'm in those neighborhoods, I'm usually counting for more than $100 a month in maintenance on those types of properties because I'll have broken windows, broken doors. Who knows what may happen in some of those areas. So keep that in mind that it's going to depend on the area of town that you're in. Where I am in the Oklahoma City Metro, it's typically 8% for good areas of town, 10% for 12% for really not great end of towns. So keep that in mind whenever you're looking. Talk to your local realtor who understands investing and who can tell you what to expect on cap rates in your particular area. So cap rate is one of the most important numbers that you need to know when it comes to real estate investing. If you're not looking at these numbers, you're probably going to end up upside down on the property. As I always say, the real money is made at acquisition. If you buy the property for the right dollar amount, you will end up at a much better stage at the end of the day, because if you pay too much for it, it may eventually catch up, but why would you want to do that? Buy it right today, that's where your real money is made. The cap rate will also keep you in check on making sure you have enough money coming in to cover all your expenses, and even if something catastrophic happens, you'll be A-okay because you'll have the money to cover the expenses. So if you've liked this video, take a second to like, subscribe, share, comment. We would love to hear from you. We'd love to get the word out about all the content that we're producing. So we've got more content coming out about personal finance, credit cards, investing, careers. We've got lots of different ideas that we're going to be putting out soon. So make sure that you take a second to check us out. And don't forget to hit the bell so you'll see when we put new content out. So I'm Brian Mullins. Thank you and have a good day.